Imagine, for a second, like every single piece of copper humanity has ever mined.
Right.
I mean, going all the way back to the days of the Roman Empire. So we're talking the copper in ancient coins, the wiring in the very first telegraph lines.
The plumbing in, every 20th century house.
Exactly. All of that, all the way up to the microscopic connections in the smartphone sitting in your pocket right now. That is over 2,000 years of digging, scraping, and refining.
Yeah.
Now, I want you to imagine having to mine that exact same amount of copper again. But instead of taking 2 millennia, we have to pull it all out of the ground in just the next 25 years.
It is a staggering visualization to try and wrap your head around.
Totally.
Because it sounds like pure science fiction, but when you look at the data we're unpacking today, it's just the mathematical reality of our immediate future.
Yeah, and that mind-bending statistic is really just the tip of the iceberg for today's deep dive. We're drawing our insights today from a translated transcript of a Dutch financial show. It's on the Gold Republic channel.
Right, featuring Willem Middelkoop.
Yeah, exactly.
Yes.
The macroeconomic analyst and financial author.
Yeah.
So our mission for you today is to unpack this massive kind of quiet shift happening in the global commodities market.
The big reset, as he calls it.
Right, the big reset. We're going to decode what this actually means for you as these global superpowers secretly, reconfigure the entire financial chess board.
But I think we should probably establish the parameters of our discussion right off the bat here.
Yes, absolutely. Good point. So we need to state really clearly that this deep dive is a strictly impartial exploration of these theories.
Right.
Regarding geopolitics, the U.S. dollar, global macroeconomics. Our goal here is just to help you understand the historical context and the data that Willem Middelkoop laid out.
Right. We aren't endorsing any of this.
Exactly. We're not taking any political sides, left or right.
Yeah.
We're simply mapping out the territory so you can, see the arguments for yourself.
Because knowledge is most valuable when you can actually understand it, apply it, right? And to do that, you just have to look objectively at what the numbers are suggesting. And right now, the numbers are suggesting a structural earthquake in how global wealth is being held, valued, and transferred.
Okay, so let's jump right into the most immediate data point that just grabbed my attention.
The Great Gold Migration.
Yes, the Great Gold Migration. I mean, get this. In just the month of June alone, China bought 173 tons of physical gold.
Which is, to give you a sense of the sheer scale of that, you have to look at the whole global supply chain.
Right.
That single 1-month purchase by China, that equaled more than 60% of the entire world's gold mine production outside of China for that exact same month.
That is insane.
One nation absorbed the majority of the planet's output in 4 weeks.
So it's kind of like, let's unpack this for a second. It's like a massive global game of musical chairs. But instead of chairs, it's gold bars. And the music is slowly fading out in the West.
Yeah, that's a really good way to put it.
Because you have one country absorbing almost everything being pulled out of the earth, it honestly feels like they're intentionally draining the liquidity of the physical market. Well, the rest of the world is distracted by paper trading.
Well, yeah, and this is a highly calculated buy-the-dip strategy executed by a sovereign nation-state. When a nation buys 60% of the global monthly supply during a price correction, they are signaling a core belief that the market has bottomed out.
Yeah.
But more importantly, and this is crucial, we have to distinguish between paper gold and physical gold.
Oh, yeah. Explain that difference.
Well, a lot of the Western financial system, they trade paper contracts, right? These are essentially just promises to deliver gold.
Just numbers on a screen.
Exactly. But China is demanding the actual physical metal delivered to their vaults, and that is a massive macroeconomic chess move.
And it's not just a 1-month anomaly either. Yeah. Like when you pull back and look at the timeline over the last 15 years, it's wild.
Oh, the numbers are staggering.
Yeah. A staggering 50,000 tons of gold have flowed into what they call the Silk Road nations.
Right. So countries like India, China, and their immediate trading partners.
Yeah. And wait, what is the total amount of known above ground gold in the world again?
So meaning everything ever mined in human history, it's roughly 170,000 tons.
So almost a third. Almost a third of all the gold in human history has quietly moved from the west to the east in just a decade and a half.
It's a fundamental shift.
And there's this deeply ironic detail in the data, too. Right now, physical gold is actually the single largest export sector from the United States.
Yeah, let that sink in.
Right. We aren't exporting cars or software at the very top of the list. we are exporting our physical gold.
The wealth is physically relocating, and I think the fundamental question we have to answer here is why?
Yeah, why now?
Why is China and, a broader East hoarding this specific form of wealth right now? And to understand that, we actually have to look backward.
To the playbook.
Exactly. We have to look at how the United States set up the current financial system back in the 1940s.
Right. So the source traces this current geopolitical maneuvering all the way back to 1942. So World War II is still raging, right?
Very much so.
But a U.S. Treasury team has already begun planning the post-war global financial system. And this planning basically culminates in the famous 1944 Bretton Woods Agreement.
Right, and during Bretton Woods, you had 44 allied nations gathering to figure out, how do we rebuild global trade after the total devastation of this war?
Yeah.
And the famous British economist John Maynard Keynes, he proposed what was actually a brilliant neutral solution.
The Bancor. Right.
Yes, the Bancor. He wanted an international global currency. It wouldn't belong to any single nation. It wouldn't be printed by any single central bank.
So nobody gets the upper hand.
Exactly. It was designed to be this mathematically pure way to balance global trade without giving one country an unfair structural advantage.
But the U.S. just flat out rejected Keynes's idea.
Because the U.S. was emerging as the dominant global victor, and they held the vast majority of the world's gold reserves at the time.
Right, they had all the leverage.
So they pushed for the U.S. dollar to be the global reserve currency instead. But to convince the rest of the world to actually trust American paper dollars, the U.S. made a solemn promise.
That it would be as good as gold.
Exactly. The dollar would be as good as gold. Other nations could hold dollars for trade, and if they ever wanted to, they could just exchange those paper dollars for physical gold directly from the U.S. Treasury at a fixed rate.
And for a while, that system actually functioned pretty well.
It did.
But jumping forward to today, the argument in the source material is that the U.S. fundamentally abused that dollar printing privilege over the decades.
Severing the tie to gold entirely.
Right, which leads to our current reality of what? A $40 trillion national debt.
Yeah.
So now China has been meticulously studying that 1942 U.S. Treasury playbook.
They're taking notes.
Yeah. They are looking to capitalize on this perceived American weakness to execute their own global financial reset.
Well, and they're looking at multiple vectors of vulnerability here. I mean, the data specifically points out military vulnerabilities, too.
Oh, yeah, the Gulf region stuff.
Right, noting that U.S. military bases in the Gulf region have recently been damaged or abandoned, and that the U.S. Fifth Fleet is, frankly, currently struggling to even project power and enter the Gulf.
Which matters because...
Because military projection and financial dominance are deeply intertwined. You cannot enforce a global reserve currency if you cannot secure the sea lanes that carry the trade.
Right. So China is sensing this opening. And their strategy for this big reset involves working with the BRICS nations. So that's Brazil, Russia, India, China, South Africa.
Yeah.
Working with them to build a parallel global trading system that is explicitly designed to bypass U.S. dollar hegemony.
And a prime example of this parallel system taking shape right now is the unraveling of the 1974 petrodollar agreement.
Okay, let's break down how the petrodollar actually worked day to day before we talk about its collapse, just so we're on the same page.
Sure. So for decades, Saudi Arabia agreed to sell its oil exclusively in U.S. dollars.
Meaning nobody else could use their own money.
Right. If a country like Japan or France wanted oil, they couldn't pay in yen or francs. They had to acquire U.S. dollars first.
Which creates a massive demand.
A constant, massive global demand for dollars. And then Saudi Arabia would take all those dollars they earned and reinvest them into U.S. government debt treasury bonds.
Oh, wow.
Yeah, it was a perfect closed-loop system that essentially funded American deficits and kept the dollar dominant.
But now Saudi Arabia is bypassing that entire structure. They're selling oil directly to China and allowing China to pay in its own currency, the yuan.
Exactly.
So China doesn't have to buy dollars. They can just print their own money to buy energy.
Right. But the catalyst for really accelerating this shift away from the dollar goes back to how the U.S. has weaponized the SWIFT banking system.
Oh, the messaging network.
Yeah, SWIFT is the messaging network that allows international banks to move money around. And recently, the U.S. and its allies froze hundreds of billions of dollars in Russian central bank reserves.
They essentially locked them out of their own bank accounts.
Exactly that.
Yeah.
When you freeze a sovereign nation's reserves, you are sending a very, very clear message to every other country in the world.
That the dollars you hold aren't really yours.
Yes. They are liabilities on an American ledger, and access to them can be revoked overnight if you step out of line politically.
Wow.
That terror, the sudden realization of counterparty risk, that is precisely what is driving China and other nations toward a gold settlement system.
Yeah.
They want an asset that cannot be frozen or deleted by a foreign government.
Okay, but I have to ask about the logistics of this, though, because it sounds a bit crazy.
Yeah.
Is a gold standard actually feasible for settling massive modern global trade? Because, dragging physical gold around the world on ships to pay for, shipments of microchips and grain, that seems incredibly clunky and entirely impractical for the 21st century. Is this just a symbolic geopolitical flex by China?
That's a super common misconception, actually. A return to gold doesn't mean returning to a 19th century model.
Okay.
The goal isn't a literal daily gold standard where every cargo ship of grain is priced and paid for in ounces of gold.
Right, that would be impossible.
The friction of daily trade is way too high for that. Instead, gold would act as a structural anchor or a net settlement mechanism at the end of a trading cycle.
Okay, walk me through what that actually looks like in practice.
Sure. So imagine China and Brazil are trading heavily.
Okay.
Brazil buys Chinese solar panels, and they pay in Chinese yuan. China buys Brazilian soybeans, and they pay in Brazilian reals.
Just everyday government-issued paper money.
Exactly. They trade back and forth all year in their own local fiat currencies. But at the end of the year, their trade isn't perfectly balanced. Let's say China imported more than it exported, and it owes Brazil $1 billion worth of value.
Now, normally they would settle that difference by wiring U.S. dollars.
Right. But in this new system, instead of settling that final net difference in dollars, they settle that specific year-end deficit by transferring ownership of physical gold.
I
And
see.
the gold doesn't necessarily even need to get put on a ship. It can simply be reallocated in a neutral, secure vault, moved from China's ledger to Brazil's ledger.
Oh, wow. So the daily friction of trade stays in local fiat currencies, but the ultimate store of value balancing the scales is just gold.
Yes, and it removes the U.S. dollar from the loop entirely.
That's fascinating. But, if this were just China and a few BRICS nations acting alone, it could maybe be dismissed as just an isolated geopolitical rivalry.
Right.
But the analysis reveals a much deeper systemic shift. The entire global banking system is quietly following the exact same playbook.
And this is where the scope of the transition becomes truly apparent, I think. We aren't just talking about retail investors or hedge funds or even just the Chinese government.
Yeah.
Central banks worldwide are currently pulling roughly 1,000 tons of physical gold out of the market every single year.
Okay, just to put that 1,000 tons in perspective for you listening, the total global mine production of gold is only about 3,600 tons a year.
Yeah, it's wild.
So central banks alone are vacuuming up nearly a third of all the new gold pulled from the earth. They are the true engine driving this multi-year rally in gold prices.
Yeah, and there's a recent report from Deutsche Bank that tracks this stunning historical curve regarding what central banks actually hold in their vaults.
I read this part. It's crazy.
Right. So back in 1980, gold made up 63% of the world's central bank financial reserves.
Over half.
Yeah. But then the U.S. heavily lobbied the global financial system. They basically convinced central banks and pension funds that physical gold was this outdated, zero-yield asset.
Just a shiny rock.
Right. So the U.S. pushed them to hold U.S. Treasury's American government debt as the ultimate risk-free, safe asset instead.
And it worked. By around 2010, central bank gold reserves had plummeted from that 63% down to just 15%.
Massive drop.
But now, the pendulum is swinging back with a vengeance. That number has already rebounded to 27%. And I think the Financial Times recently highlighted that gold has officially replaced U.S. Treasuries as the world's top reserve asset.
Yeah. And Deutsche Bank predicts that gold will actually continue to climb until it once again makes up 30 to 40% of global central bank reserves.
Wow.
And if that capital rotation happens, if trillions of dollars continue moving out of paper sovereign debt and back into physical gold to reach that 40% allocation, the mathematical consequence is a massive revaluation of the gold price.
What's the number?
Well, Deutsche Bank estimates it could push gold to between $12,000 and $14,000 per ounce.
Wait, $14,000 an ounce?
Yeah.
That sounds like absolute hyperbole. How does Deutsche Bank mathematically justify a number that high without assuming, a total apocalyptic collapse of the global economy?
Well, it's actually a straightforward denominator effect, not necessarily an apocalypse scenario.
Okay.
It's all about the ratio of paper money to physical assets.
Yeah.
So over the last 2 decades, central banks have printed trillions upon trillions of dollars, euros, and yen.
Right, the money printer going brrr.
Exactly. The denominator, the total pool of currency has just exploded, but the numerator, the physical amount of gold, grows by barely over 1% a year.
Oh, I see.
So if central banks decide they need to back even a fraction of that newly printed currency with a hard asset just to maintain credibility,
Yeah.
a massive amount of capital has to squeeze into a very tiny physical market.
Right.
The only way the math balances is for the price of the physical asset to adjust upward dramatically.
So what does this all mean? It sounds like central banks are quietly buying fire insurance on the U.S. Treasury House while publicly smiling and telling everyday citizens, the neighborhood is perfectly safe.
That's a perfect analogy. They are preparing for a macroeconomic environment where the counterparty risk of holding another nation's debt is simply too high.
But this brings us to a really scary pivot. If central banks are hoarding the ultimate monetary metal because they don't trust the system, what happens when that same hoarding mentality hits the metals we actually need to build things?
Right.
The deep dive takes a turn here from monetary scarcity to hard, physical, industrial scarcity.
Yeah, and the physical reality of the commodities market is pretty disturbing right now because despite massive price increases across the board, we physically cannot dig metals out of the earth fast enough to meet projected demand.
Yeah, look at the numbers. Global gold production is essentially flatlining. In 2018, the world mined 3,663 tons of gold. The projection for 2025, 3,672 tons. That is virtually zero growth over 7 years, despite the price of gold skyrocketing.
And silver is even worse.
Right.
Total global silver production actually peaked 8 years ago, back in 2016, and is now significantly lower.
And there's a massive disconnect happening here, too. You've got physical metal prices soaring, but if you look at mining stocks, they've dropped by roughly 40%.
Yeah, because the market is punishing producers. They simply cannot increase their output to take advantage of the high prices.
But this disconnect is attracting some heavy hitters, like billionaire John Paulson, the hedge fund manager famous for executing the big short against the housing market during the 2008 crisis.
Yeah, legendary trade.
Right. Well, he is looking for his next massive trade. And he has concluded that the ultimate hedge against central bank money printing is unmined gold. So he just acquired a 40% stake in NovaGold, which is a massive undeveloped gold project in Alaska.
And you might ask, why buy it in the ground instead of buying physical bars or standard mining stocks?
Yeah.
Well, by buying an undeveloped deposit in a safe jurisdiction like Alaska, he completely avoids the immediate jurisdictional risks of mines in unstable countries.
Oh, that makes sense.
But more importantly, he is buying optionality.
What do you mean?
Well, the gold is insulated from the current vicious inflation of mining costs like diesel fuel, labor, heavy machinery because he doesn't have to mine it today.
Right.
But he still owns the rights to the commodity itself as the global price appreciates. It is just a massive bet on future scarcity.
But the true crisis, like the ultimate bottleneck for the global economy, isn't gold.
No, it's not.
It's copper. We have to circle back to that visualization we started with, having to mine 2,000 years of copper in the next 25 years. The sheer volume required for the energy transition and the digital revolution is mathematically staggering.
It really is. Think about this. A traditional internal combustion engine car uses about 15 kilograms of copper for its wiring and components.
Okay.
A single electric vehicle, like a Tesla, requires roughly 100 kilograms of copper. Now multiply that by hundreds of millions of vehicles globally.
And then you factor in the explosive growth of artificial intelligence. AI data centers are massive, unprecedented sinks for copper wiring, transformers, and specialized cooling systems.
Yet, just like with gold and silver, the copper mining industry is hitting a brick wall.
Yeah.
Recent production data from major global producers, we're talking giants like BHP and Rio Tinto, shows their copper production actually dropping by 6 to 7% year over year.
Dropping.
Yes. Codelco, the giant Chilean state-owned mining company, is also seeing negative production growth. We are rapidly entering what the source calls the era of shortages.
Okay, I have to play devil's advocate here because this is where a lot of people get confused.
Sure.
If demand is absolutely skyrocketing for AI and EVs and the price of copper is sky high, why can't these massive multi-billion-dollar mining conglomerates just I don't know, flip a switch, hire thousands of new workers, buy more trucks, and just dig faster? Like, are we actually running out of planet to mine?
Well, I mean, you cannot simply flip a switch in global mining.
Right.
The issue isn't a lack of money or manpower. It is a structural supply-demand failure that is literally rooted in geology. Old legacy mines are becoming exhausted, and we are dealing with severely declining ore grades.
What does the declining ore grade actually mean for the physical mining process, though?
Basically, it means we've already picked all the low-hanging geological fruit.
Okay.
20 years ago, a mining company might dig up a ton of rock and extract a significant amount of high-quality copper from it. Today, to get that exact same amount of copper, they might have to dig up, transport, and crush 3 or 4 times as much rock.
Which requires 3 or 4 times as much diesel fuel for the haul trucks.
Exactly. And far more water for the processing and exponentially more electricity.
Right, the costs just ballooned.
Yes, the energy cost to extract the metal is rising faster than the price of the metal itself. The math just breaks down.
Right.
And discovering new high-grade veins is becoming incredibly rare. But even if a geologist finds a massive new copper deposit tomorrow morning, the regulatory, environmental, and engineering timeline to actually permit and build a new megamine, it takes 15 to 20 years.
So it wouldn't even help us now anyway.
Exactly. You cannot replace depleted global mines overnight, no matter how high the price goes. The physical reality of the Earth's crust is finally colliding with the infinite growth models of the modern economy.
Wow. We've covered a staggering amount of ground today.
Huh.
We started with China quietly absorbing 60% of a month's global gold supply,
Yeah.
draining physical liquidity from the market.
Yeah.
We traced that strategy all the way back to the 1944 Bretton Woods system, the breakdown of the petrodollar, and how the weaponization of the SWIFT banking system basically forced BRICS nations to seek a neutral settlement asset.
Right.
We looked at central banks worldwide pivoting away from paper U.S. treasuries and back toward physical gold, which is driving this massive mathematical revaluation.
Yeah, that $14,000
Mhm.
prediction.
Exactly. And finally, we hit the hard wall of geology. Declining ore grades and the physical impossibility of mining enough copper and silver to actually sustain our technological ambitions.
Which is to say, we are moving from an era where wealth and power were defined by paper promises and digital ledgers back to an era where they are defined by tangible physical assets.
And that is exactly why this matters to you. The digital green future you're constantly being promised, the electric vehicle fleets, the AI revolution, the seamless renewable energy grids, all of it is entirely dependent on physical finite resources.
Yep.
Resources that global superpowers are currently fighting tooth and nail to hoard. The Big Reset isn't just an abstract financial theory debated by economists. It is a very real battle for the physical building blocks of the 21st century.
Which leaves us with a critical question to consider as this global chess match continues to unfold.
Yeah, what's that?
If the foundation of our next great technological leap, whether it's artificial intelligence or global green energy, relies entirely on physical metals we are struggling to pull from the Earth, will the true superpower of the 21st century be the nation with the most advanced algorithms, or simply the nation holding all the copper and gold?